Okay, everybody, we're gonna get started. Just let's make sure all our panelists are unmuted. And fantastic. So my name is Mark Feld. I run the Riverside Experience. We are a division of Riverside Abstract, one of the most active title agencies on the East Coast. And we are here for you guys. We are very much open and very active. And we are also a 1031 exchange intermediary, as well as we offer cost segregation studies. So that's just a little background on Riverside. So today we're going to focus on multifamily in light of what's going on. And we are lucky enough to be joined by two phenomenal panelists. Number one, we're joined by Ellie Perlman, who is the founder and CEO of Blue Lake Capital, a firm that specializes in multifamily acquisitions. She's also a real estate attorney who received her degree from MIT. So we're very excited about having her today, as well as a good friend of mine, an old friend, now becoming somewhat of an old friend of mine, Frank Forte, who is the founder of Lucern Capital Partners, which is a real estate private equity firm that focuses on making value-add multifamily investments. And we're going to focus on three areas. The first area that we're going to focus on is kind of a big picture view of the multifamily market, where things are headed. Next, we're going to talk a little bit about finding and underwriting new deals in light of what's going on. And third, we're going to talk about some of the operational and managerial adjustments that you've been making in order to weather the storm. So, Frank, you sent out an excellent newsletter, one of the best I've seen actually throughout all this, on your long-term view of the multifamily market. Can you sum up your thoughts? I know we're going to actually send out that newsletter. Yeah, so if you can, why don't we start off with you and try to, sum up your thoughts?
Sure. Yeah. And thank you for having me. And thanks to the whole Riverside team. You guys always work hard to put on great events. So we're always happy to be part of it. So as Mark said, I'm Frank. I'm one of the principals of Lucern Capital Partners. We're a real estate private equity company headquartered here out of New Jersey, a little bit less sunny than Santa Monica, but we'll take it. We invest up and down the East Coast, and our portfolio has fluctuated. Today, it's probably somewhere around 50 million plus or minus. Now we're kind of scaling it. Hopefully, should get to 100 million this year. So, as Mark said, my newsletter was very long, and that goes to show you what quarantine and days inside sheltering in place can do. Don't have much time to do anything else. But look, here's what we think. We are fervent believers in the durability of the multifamily market. We think it's probably the most resilient real estate market in the country. We think it is universal, right? Everyone needs a place to live, and obviously that's far overused, right? Everyone needs shelter, but the truth is, your tenant base in multifamily is a universal tenant base, right? It's really just dictated by price if someone's willing to rent or not. We think that's a huge counter to the office market and retail, where tenants have a very specific, sort of box of what they look for and build out, and location is important for foot traffic and, or even industrial tenants, right? So they have certain power and certain amenities in their space to dictate whether or not a certain business can operate. So the universality of the tenant base is huge. We think it's durable and resilient. And ultimately, we see it as a very strong alternative to other, we think eventually with where treasuries have gone and where the debt markets have gone, we think eventually over time, real estate, specifically multifamily, will become very analogous to fixed income investing. So when you have the treasuries that are incredibly low, right, probably 60 basis points as of today, you have the stock market, it's up and down, it's incredibly volatile. We see this as a long-term store of wealth, a way to generate income for both ourselves and our investors, and ultimately a very resilient place to put your money. I mean, I think you could even argue today, if you were a bond investor, that there's a very high probability you could face a capital loss at some point in the future. It may not happen, in the short term, but if you're a hold to maturity, fixed income, you're on a fixed income, you're maybe an older person, you have some wealth that you've created and you've dumped it in things like bonds. I think there's a real chance in the next few years, and we think it's some time out, but I think in the next few years, you could see a capital loss as interest rates creep up, by the way, ever so slightly and erode ultimately the principal balance of your investment. So we think it's durable. We think it's resilient. We think interest rates are going to remain low for the next 2 to 3 years. We think inflation is going to be tepid. Part of that is oil is going to hold down inflation for some time. The fact that we are kind of the cleanest out of the dirty laundry of the world in terms of where you go for financial strength, that's going to be very challenging as folks rush into the treasury market and rush into the fixed income market, and that's going to hold down rates, we believe. And then lastly, I think it's really hard to argue with the strength of the dollar. And normally you wouldn't expect, when currency devalues, which we're going to see a lot of with the overwhelming amount of stimulus and effective QE and other programs that have been pumped in, money creation is rampant. Normally you'd see a devaluation of currency, but we feel that with what's going on and our position in the world, especially as the world's reserve currency, but more importantly, the world's trade currency, we think it's going to be very hard for the dollar to weaken. And as a result, to strengthen the dollar, persistent weakness in the oil market, persistently low rates, QE, stimulus, we think that inflation is going to remain low for a long period of time. And as such, will be good for real estate values. Look, at the end of the day, there's a housing shortage in America. There's been one for a long time. It's going to continue. So folks need a place to live, and most markets, especially core and secondary markets, are still, with all the building going on, they're still undersupplied. So we feel that's going to be very positive for rent growth. Valuations will be propped up by low cost of borrowing. And ultimately, it's going to remain a very attractive investment relative to other public market peers moving forward.
And Ellie, do you share a similar view? And what is your long-term view as well on the multifamily market?
Sorry. Yeah, I would say generally speaking, I do agree with Frank. I think that real estate in general has proven to be very beneficial if you're playing it right, if you're playing it for the long, if you're looking at it as a long-term hold, then yes, real estate is one of the strongest investments out there, but real estate is a very kind of broad concept. So within real estate, you obviously have retail and office and multifamily, and compared to all the other asset classes, multifamily is really, is very strong. And I wouldn't say that it's not really, I would say it's resilient to crisis. It's not 100% resilient because there's no, guaranteeing any type of real estate or any type of investment. But I think when it comes to real estate, when it comes to multifamily, it's extremely important right now to look at the markets, look at the tenant base, and understand where the good deals are. And there are good deals, but there are also a lot of bad deals even today, even 3 months ago and 2 years ago. And so I truly believe that the fundamentals are still there. If you're buying a property with a solid tenant base in a good area with diversity of employment in the area, and also if you're positioning yourself in, for instance, Class B, which we're huge believers in Class B investments, I think that this would prove itself as the right course of action, as a very conservative and resilient investment. So there's no proof from any type of crisis, but you can play it smart. And I would say, it's interesting because I see a lot of investors that are a little bit hesitant to invest today. I think investors should have been very hesitant to invest a year ago when everyone was overpaying, and now you see who basically overpaid for properties because those investments are making, it's pretty hard to make, profit at this time. So if you bought it right, and it's harder to buy right when the market is very, very hot, then if you bought it right, now you see, which investment was actually a good investment. But generally speaking, yeah, I think the fundamentals are there. We try not to give in to fear, and we see every opportunity as, as an investment, a potential investment. And we're stress testing. We'll probably get into it later. But generally speaking, yes, I would say Class B investments are probably the most reliable type of real estate assets or real estate class that we, recommend investors to focus on. And if you're looking basically at 2008 and you're looking at today, Class A got the hardest hit. Class C did pretty well in 2008, but Class C got a pretty hard hit. And it's pretty understandable because we're talking about workforce housing and a lot of people that work for small businesses that basically were left without a job, without income. And Class B continuously, that's the asset class that continued to perform in the 2008 crisis and continues so far to perform in today's market. However, I would say that it could be a little bit early because we've gone through 1 month of collections. So we're speaking now, it's April 30th. We're probably going to know in about 10 days how, May turned out and what happened in, with May collections. But overall, 95% of rents were collected during April. And so that's something to really remember and think about, that even when everything around us seems to be crushing down or changing rapidly, businesses are closing, you have an enormous amount of tens of millions of people that are applying to unemployment. 95% of rents across the country were basically were basically collected. So that's one very important figure to remember. And even within that figure, 95%, you have the different types of Class A, B, and C. And obviously there's variability there, with Class B being the strongest out of all three classes.
So before we talk about moving forward, let's just get a better understanding of, I want to understand what a typical deal has been. So why don't let's start off with Frank. Tell us about one of your past deals, then what your typical business model is for your acquisitions.
Yeah, sure. So we're focused on risk-adjusted yield first and foremost, and a lot of that is derived from value-added and opportunistic investments. So opportunistic, investments 3-4 years ago, they still existed, right? They were kind of creeping around, and you could find them. And kind of like Ellie said, there's a lot of really crappy deals out there that other people shop around and kind of sell it to you like it's the moon. And that's kind of something we could talk about later, in the value of relationships and knowing how things that you're, being brought are quality if someone brings it to you and where the source is. But so we started out in Class B and C. And early on when we started out in C, we did it because the cap rates were tremendous. And even adjusting for things like delinquency and increased maintenance and non-revenue generating CapEx upfront, that sort of thing, the returns were incredibly compelling. And really what we saw happen over the last few years is everyone rushed in, kind of to Ellie's point, like workforce housing became the go-to word. And I was a banker during that time. And I remember when, Fannie and Freddie released, our workforce housing guidelines. And all of a sudden, like no one, everyone and their mother knew what workforce housing was, right? And this is workforce, invest here, invest with us, it's workforce. And really what happened was the cap rates got bid down to nothing, right? And at the end of the day, it was the same tenant base. Nothing had fundamentally changed with the tenant base. It's a segment of the economy that, unfortunately, for structural reasons in the country, wage and income growth for those folks has been the lowest out of any other class, right? And as you know, Mark and I were talking about this earlier, the wage and wealth gap in America has widened dramatically. And it's always been wide, right? But it's gotten worse. And so you have folks that, fundamentally, when you're buying a product like that at a 5.5 cap with very little expected rent growth, especially in a rent burdened area, let's call it a New Jersey, a California, right? Where Ellie is, or even New York, at some point the rent growth is going to stop. And when rent growth stops, the wind kind of comes out of the sails of any of these products, right? There's only so much back end value you can derive. I like to say this, right? Valuation is comprised of two things. It's either NOI growth or cap rate compression. When caps are compressed to nothing and there's no NOI growth, what happens? You really don't have any pop in value, right? So all these value add business plans are predicated on the ability to move rents. And we thought that in short, in summary, was extinguished from the C quality market. So we cycled out of our C quality stuff. We rode cap rate compression and significant NOI creation, and the numbers we put up were crazy, right? Not once in a lifetime numbers, but unbelievable, right? Type of stuff we didn't even believe was possible. And then we cycled into a lot of B quality product, because what we saw was the cap rates on B and A were at their narrowest against C. So you look at that and you say, all right, most of the B quality product is a little bit newer, less revenue generating CapEx, easier operation from durability of cash flows, more resilient tenant base, and we started to cycle into that, still with the value add sort of business plan. So our typical deal, I would say, is the markets we're mainly focused on right now are in the Northeast. We're mostly focused on Philadelphia. We think there's a huge story there with cost of living and the diversity of the wage and income base. We focus on areas over 5 million, with population diversity in the base and income strength. And then, of course, we're down in the Carolinas and Charlotte, Raleigh, and we find those areas to be so compelling for a lot of different reasons. But our typical deal will be somewhere above 10 million, probably with a cap of maybe 30 to 35 million. Strong potential to move the rents. The minimum sort of rent movement we would consider is probably 15%. And then we would look to buy, in core kind of locations in the location. So we don't go to tertiary markets, kind of for the reasons you're seeing now, right? I mean, I came from an institutional real estate background, and when you chase yield like that and you go out to some, east of nowhere sort of place that's an hour outside of a major metro, when the market turns like it is now, those are the first areas where the cap rates blow out, right? Because usually there's not diversity of income. They're linked to one or two employers. It's far from critical infrastructure. And more importantly, you're not gonna, it's only in good times that you see the urban sprawl happen, where the folks that are on the edges start to benefit from upward growth, right? But the core, the urban core, and even the suburbs, surrounding those areas are always going to be resilient, and there'll always be a need for housing. So we focus on those areas, and we like to buy in good locations, sometimes in the path of progress, sometimes just core locations with good upside. And, we like to buy well. We don't just buy anything. We're very selective, and ultimately, we've done very well like that. But, we see probably 100 deals for, every 5 we look at further. And then out of those 5, maybe 1 we move forward with. So it's very hard to find quality product. It's there. You just have to, you just have to be ready to look for it and then execute when it comes across.
So Ellie, let's go to you now, and let's discuss some of your past deals and what your typical business model is as well.
Sure. So Blue Lake Capital owns about 2,000 units. We're focused on a few markets, Texas, Florida, and Georgia. And within those markets, we like to be within 45-minute drive from a major metro, from basically the downtown area where most of the employment is. So our focus is, for instance, Atlanta, DFW, Tampa, and Jacksonville. These are some of the markets that we're looking into. And basically, when we started, we actually started with Class B because we kind of looked at what happened in 2008, and we said, hey, we believe in Class B, and we think that would be the most, I would say, when it comes to Class B, and I'm trying to find the right word for it and be very accurate, but we believe that the Class B is the most, there's a lot of security when you buy those assets. I'm very conservative. I used to be a lawyer, so the conservative mind never leaves a person once they become a lawyer. So I tend to, when I'm looking at a deal, I tend to see all the wrong things that can happen, everything that can basically go wrong is what I see in front of me. And so when it comes to Class B, there are a lot less things that could go wrong, and everything can happen at any deals. But when it comes to our strategy, we usually like to purchase 100 to 400 units value add deals. And when I say value add, I mean, you buy a property in a strong location with a very solid tenant base, and you recognize some inefficiencies. So in order to take a property and make it more profitable, like Frank mentioned, there's either you buy it at a certain cap rate, you sell it at a lower cap rate, or you improve the cash flow, or both, which is what we're trying to do. So when we're looking at cash flow, we're basically looking at two components. We're looking at income and looking at expenses. When it comes to expenses, we're reviewing everything. And usually our strategy is to look at all the expenses and think, how can we creatively cut costs so our bottom line is higher? Maybe the owner, and we see it a lot, that owners are trying to manage their own properties and save money, but they leave so much money on the table because they don't have the right capability of managing
It's like trying to sell your house yourself, right? It's
Exactly.
Penny wise and pound foolish.
Exactly. And we see it over and over and over again. It could be the little things such as, the owner doesn't know that the average, rates, the average rents are $1,000. They think it's $900, and they own, 100 units. Now you do the math, how much money they're leaving on the table because it's not their profession. And so that's one of the areas we're looking at when it comes to costs. Sometimes you have property management companies that are managing in a very inefficient way. And we are able to say, okay, we can, instead of 65% expense ratio, we can cut it to 60 or 50 or 55. And that's a huge, addition to the net operating income. Now, the other part, and that's the more fun part, in my opinion, is looking into the income and saying, what can we do to increase income? Part of it can be just buy a property where the rents are under market and push them to market. Now, and I'm going to talk about how we are strategically going to do it after the pandemic or during the pandemic. But that's one area. And then we're looking into the units. We're basically looking into the competition. We're touring the competition. We're calling and we're asking what the rents are. And then we have a pretty good picture of what is the average rent and what the other competitors are offering. So if the guy across the street is charging $200 more for the same size apartment with the same number of bedrooms, but they have stainless steel appliances and faux wood flooring, and we're still in the old kind of style with white or black appliances and carpet throughout the unit, then we know what we need to do in order to push rents at least by $100, so we can still position ourselves a little bit less than the other guy across the street. So that's kind of the strategy that we were focused on. Light value add, where you take a property, doesn't have a lot of problems, but you just make it slightly nicer so you can justify pushing rents. Usually push rents between 15 to 25% with success. And our strategy is very conservative. We're never evicting people and taking an empty property and then renovating everything. We're going to start with the vacant units. We'll renovate them. We'll wait and see how the market reacts to it and adjust our renovation based on what we see in the market, based on how easy it is to lease the units. Now, all of this is changing because right now the reality is that owners are adapting to this the new situation in the world. So for instance, we offered tenants early bird discounts if they're going to pay during March for April rents. So nobody's really, and we're doing the same this month if they pay until today before May 1st, which is the first day to pay for May rents. And this kind of thinking helped us, among other things that we've implemented, to collect over 99% of rents during April across all of our properties. But that means that, the fact that it succeeded, it also shows that the thinking has changed. We're not looking at deals right now, new deals in the market, with the lens of value add and thinking, okay, we're going to buy this property, we're going to renovate 70% or 50%, push rents by $200, it's not going to work. And I wish that I'm wrong. That would make all my new acquisitions extremely profitable. But the truth is that things have changed. So our strategy, first deals that we've done were Class B in solid areas, light value add, getting those 20% rent increases, or usually spend $3,000 to $7,000 per unit. It proved to be working pretty well. But now the world is different. And basically, when we're underwriting, we're looking at it very, very differently. And I know we're probably going to get into it, but the strategy is definitely changing. And even if we think we can implement a value add plan, it's not going to be in the next 12 to 18 months. So everything is kind of being pushed because I think it's going to take time for the economy to bounce back. When we just started, I thought it's going to be the dip is going to be kind of like a V shape, where there's going to be a major pain in the short term, and then a major, very quick recovery. And obviously we're not in that environment. It's more like a U shape. So it's going to take time for people to find new jobs. A lot of businesses are not going to come back. They didn't get the PPP loan, or it wasn't enough. And there's going to be some pain in the market, but still there are still good deals out there. It's just, you just need to be very realistic about the assumptions you're making when you're analyzing and underwriting those deals.
Okay, amazing. So, Frank, I think it seems like both of you guys mentioned a diversified job base as a very important factor in the geographic locations that you choose for your investments. Is there been, but we're seeing in a crisis like this, we are seeing even in diversified job markets, we're learning that there are crises that can come up and take out whole industries such as hospitality. What are you learning? What have you learned about this crisis that you'll keep in mind going forward for even for picking the next for a geographic location going forward? Does that make sense?
Yeah, no, it does. And I think to answer it almost backwards, almost the reason we've picked the markets we've picked is because we feel that it's, there's a lot of disposable income, right? There's a high take home rate in pay. And, what that means is, and I'm sure Ellie looks at this too, is, an area like a New York or New Jersey, right? You have 38 to sometimes 50% of your income is being lost to rent. So areas that we're in, like in Philly and the Carolinas, we're 20%, 20.5%, 19, 21, right? It's very low. So we start with saying, all right, how affordable is this economy relative to other markets in the US? And that's our first kind of thing to judge durability. Then we go and we look at the diversity in the job base. So an area like Charlotte or Philadelphia, for instance, has retail, you have trade, you have biotech, you have startups in a lot of these places now, you have big business, Fortune 500 companies. So you have this wide variety. So you're not anchored to any one particular industry. Like when I was a bank, I'll give you a great example. When I was a banker, we'd see a lot of military housing deals and we would turn them down, right? Because you have, one, the military is the only employer in some of these, middle of nowhere places. And two, if you, God forbid, you have a deployment, and it's not like the U.S. hasn't been, bellicose, right, on the world stage, going and deploying folks wherever. And, you see instances where occupancy will go from 90%, let's say in a market like Fayetteville, which became really popular in the last crisis because it was, 100 basis points better yield. Some of those folks, they got a big deployment and, now they're at a sustained 80% occupancy. They can't get above it because there's no other generators. So we look for the durability in the cash flow. We look for, the spread between what folks are making and what they're paying. And what that does is in an environment like this, where everyone loses their job, it's a much lower bar for these folks, and they can still pay their rent, right? And maintain their living, right? They can buy food, they can put food on their table. If they have to pay for their children's daycare, they can do things like that. They can pay their car payments, right? people need a car to get to work. So it's important to remember that, it's not just diversity in the base, but it's being in a situation where you allow that you're not squeezing every last dollar out of someone, and they're not burdened to the point where the smallest hiccup in their life can, adversely affect their ability to pay. So that's how we kind of start and look at markets. And that's also why we look for markets with 5 million or more folks, because if a tenant does go bad, and it happens, people lose their jobs, things happen, you have, replacement. We're not anchored to a market where, it's 20,000, folks in one particular city. And then, there's 10, 15 complexes that service them. And, once you kind of run out, it's hard to fill. When we run out of when a tenant vacates or we have an occupancy, most of our properties, depending on location, they're filled within a week. Maybe the tenant doesn't move in a week, but we have someone lined up who's going to move in. So our vacancy loss is low, and we're able to control operations. So we do rigorous tenant screening. We select locations with wide geographies and employment bases. And that's the beauty of workforce, right? In a way, and what I will be is what I call workforce plus. You have your nurses, your truck drivers, your electricians, your restaurant workers, right? A middle manager at some sort of sales company, right? Pharmaceutical reps. I mean, it runs the gamut. So you have a wide diversity of folks that you can bring in, and it becomes very universal. So you have that backstop always. You're not ever out there looking for someone for too long. But, I think this is going to bring to light a lot of the same challenges that we saw in 08, 09, where people got way over aggressive on Las Vegas. And last time, it was for a different reason, right? This time, Vegas's economy has been it has changed so rapidly over the last 10 years from entirely, 10 years ago, it's probably 80% hospitality, leisure, and, nightlife based. Now it's closer to 47, 48, which is still tremendous, much different. I think you're going to see the opportunities in Vegas. It's always been a boom bust city, and you're going to continue to see that. I think what caught a lot of folks by the short hairs, and thank goodness Ellie's not there, is Orlando, right in the middle of her Tampa and Jacksonville targets, because Orlando, the growth in Kissimmee and Orlando has been like, neck breaking in the last 10 years, and industries moved down there, no, state income tax, lower tax brackets, homestead exemption. So you have all these folks from the Northeast moving down there. And I think what they forget is that Orlando still has been, retail and hospitality focused for a long time. So I think Orlando, Nashville, some of those areas, I think caught folks a little flat-footed. So we try to stay in, like I said, the areas we think there's much growth as possible, low cost of, share of the wallet, let's say, towards rent, and ultimately, universality in our tenant base.
And so I want to talk to you guys about new deals going forward, and deals that you've been seeing recently. Have you been able to see, we'll start off with Ellie on this one, seen any adjustments in pricing?
Yes and no. So what happened before the coronavirus era, which I hope is going to be a very, very short one, a lot of investors thought that, we're the 7, 8, 9 years of expansion were way too long, and everyone was waiting for a correction, I think, for the past 3 years. And some investors said, we're going to hold off. I know Sam Zell, which is a billionaire real estate investor that I highly recommend reading his book. And he's a very, very successful entrepreneur and real estate investor. He's been sitting on billions of dollars, I think $3 or $2.5 billion, because he was waiting for the right opportunity, because everyone knew that this is not sustainable. This growth has to stop and things are going to change, but we didn't know when and what the source would be exactly. And a lot of investors actually thought, okay, once, we know that this is 10 years of growth and that this has to stop at some point. We're going to wait until there's going to be an economic crisis. Then we're going to buy all the deals that are going to be out there. They're going to be great opportunities. And I think many are a little bit disappointed. Everyone is waiting for the best deals out there, and they're not there. And there's a reason why. So there's a very small portion of deals right now that are still in the market. Most deals, I would say probably around 80 to 85%, the seller basically paused the sale because they know that in order to make the sale, they'll have to get a price cut, and that translates into probably millions of dollars, if not more. Because if they have a dip, even a temporary dip in April collections, investors like me who are underwriting deals are going to try and quantify the risk of buying anything now. And that means, we're increasing our bad debt, which is the delinquency number. We are reducing the rent growth. For me, it's flat for about 12 to 18, maybe 24 months, which is very conservative, but just to be, to be on the safe side. And so everyone was waiting for good deals to come out of this crush, and it didn't happen because most sellers don't have to sell. If you don't have to sell right now, you're not selling. It doesn't make any sense because you're going to have to sell it at a much lower price. So sellers prefer to pause for now, wait until the pandemic is over, wait until they can get back the collections back to normal. And it can take 3, 6, 9 months. If they can wait and they don't have to sell, that's what they do. And in most cases, they take the long term that they have allows them to stay in the game for much longer. So if we buy a property, so we're syndicators, we're buying properties with investors, we usually buy for 5, maybe 7 years. So if I buy a property and I plan to hold it for 5 years, I put debt on the property, usually agency debt, Freddie, Fannie, with the term is longer than the hold period. So if I buy a property for 5 years, I place debt for 7 or 10 years because of situation like this one, I don't want to be forced to sell at a certain time if it's the absolute wrong time to sell. So if the 5 years were ending now, I would be in a really, really bad situation. So I want to give myself a little bit more of a leeway, and most sellers are in that space, or I would say a lot of sellers. So if they don't have to sell, they're not selling. And there's a gap between buyers and sellers' expectations right now because it's a little bit more risky because there's unknown, and unquantified unknown leads to confusion, leads to freeze in the market. And a lot of basically, even for me as a buyer, I say, hey, I'm not really sure what how May collections in June and collections are going to be, and what really is going to be the state of your property in the next 6 months. I want to be compensated for that risk. And usually buyers are looking for 15 to 20% rent price reductions, and sellers are not willing to give that because they prefer to wait for 6 more months and not give 15 to 20% price cuts. And that's what's happening in the market. So there's a little bit of a freeze because most deals are not back in the market yet. It's the sellers are waiting. And in addition, you have forbearance. So a lot of lenders who saw what happened in '08, who have no interest in foreclosing, because then it would be pretty significant. They allow owners to use forbearance, basically pause for 90 days on payments, on the debt payments. So that gives a little bit more flexibility to owners. And that's what we're seeing right now, where you have some deals. I have more off-market deals than I've had before on my table, but a lot of sellers are not willing to move forward because they have the option to keep holding on to their properties.
Frank, I want to pivot a little bit. You have a background in lending. How's your conversation going with lenders out there?
Yeah, so I think for a while it was very it changed rapidly. So I think when this whole thing first happened, let's call it early to mid March rather, the markets froze, right? The CMBS market, which has generally been, kind of candidly a crap market for financing multi, it seized up, and which is no surprise, right? It's mostly backed by retail and office and strip centers and things of that nature. But look, I was an agency banker, right? Agency is the lender of last resort. It's always been there. It'll always be there. 2008, 9, more agency loans were done in New York City. To give you an example, and I know you understand what this means, Mark, and I'll explain it to everyone, but New York City is a really unique market, right? Where the big banks, the NYCBs of the world, the signature banks dominate the marketplace, and they gobble up all of the share of loans. 2008 and 9, those guys vanquished from the market, right? In blink of an eye, they were gone. And the agencies came in and they wrote a ton of loans. And I remember when I was a banker, a lot of the stuff we were seeing rolling off was 5 and 7 year paper from when the crisis happened. And you're looking at it like, this is crazy how many New York City buildings were financed by agencies. So I think coming roundabout to your question, I think the agencies are there and they're open. And I'll give you a great example of what that looks like. So we, to a little bit to Ellie's point, there's a lot of off-market deals floating right now. It's very important you trust the source of your relationships. And if you've built good relationships, you will see the quality deals. So I'll give you an example. We were shortlisted 2 weeks ago for a $31 million asset in Charlotte, nationwide pension fund, one of the oldest pension funds in America. If I said the name, you would know it. $500 million portfolio, okay? And there was one asset in Charlotte, and the rest were kind of scattered, and they were collecting portfolio bids and one-off bids. This pension manager, like many other pension managers, had to rebalance because the market took such a beating, the stock market. So their real estate and public equities were out of whack. So they said, look, we have to sell this. We're going to do it later this year. Let's put it on. And they were guiding price down 12% to begin with from where they BOV'd it just a few months before. So this is an asset with value add capability, even if not for the next 12 months, for the equivalent of 100 basis point cap rate increase over where you would have bought it at just a few months prior. So we were shortlisted and we have very good agency relationships. I went to my agency guy and said, look, this is the deal, give him the rundown of everything. Here's where we bid, et cetera, et cetera. We received a quote for, and this is B, run of the mill kind of B product, but unbelievable location within the location, really good pocket, strong quality asset, institutionally maintained for the last 10 years. And we got a quote, 3.6, right? 5 years of IO, full leverage. And that gives you kind of a great indication of how aggressive the agencies will be for mission product, workforce product that fits their box, for good sponsorship where they've worked with before in quality markets. So if you have a good deal, the right money will come. And that's always what it's been, whether it's equity or debt. If you have a quality deal, the money will be there and you'll find a way to get it done. And, again, I think you can't underestimate or undervalue, how significant relationships are in a time like this. We were shortlisted. We had 2 other competitors. We made it to best and final, and it was 2 of us. They threw 1 guy to the wayside, and then versus 2 portfolio bids. And ultimately what happened was, to my deep dissatisfaction, of course, the pension fund decided not to sell at all because the stock market came roaring back and they didn't have the pressure. So they said, hey, why would we sell now for 12% discount, which, amounted in this deal to a fairly significant amount of money, several $1 million, versus selling it later on this year with no pressure. Like Ellie said, they have no pressure to sell right now. So the other thing that we're seeing a lot of is we're seeing a lot of rescue capital deals. So my background outside of being a banker was in turnaround and, distressed kind of asset management and really funky sort of messed up situations. So we happen to see a lot of those deals. So we saw a deal recently. It's in the Northeast. We're very close to going forward with it. I can't give the details, but we're going to come in as a pref equity position, maybe even with a touch of mezz. And what we're going to do is we're going to recapitalize the structure. We're going to negotiate with the lenders that are in place. The leverage on the deal right now is too high. So we're going to come in, we're going to recapitalize that. And this asset was hurting a little bit before for, some other reasons. And the pandemic has just kind of exacerbated that. So we're going to step in, we're going to give our investors a really good risk-adjusted yield for being in a, semi-secure position. And we think we're going to be able to generate, significant yield. But this is why you have liquidity, right? And this is why you set yourself up. So when you do see these opportunities, going back to Ellie's point with Sam Zell, he was maybe a little too early to the party. He went to cash like 4 years ago. People are like, Sam, when are you going to hop in? And he's like, I'm going to wait. I'm going to sit around and do whatever, donate some of my money, whatever. But now that he's here, he's like super excited because it's finally coming true. but I don't think we're going to see the type of contraction you're going to see in the hospitality space. You know, TREP, who is a big company, they monitor all the CMBS loans across the country, and they provide default rates and things of that nature. They think there's going to be a 35% default rate for hospitality and leisure. 35%. That's like mind blowing, right? You know, the financial crisis was like 10 or 12, but then you look at multi, and they think it's going to be like 25, 30 basis points. You know, historically over the last few years, it's been like 10 basis points. So yeah, is it doubling? Sure. Is it significant? No. So, you know, I think there'll always be one-off deals where people get over their skis and you can come in and make a difference. But I think by and large, sadly, I don't think there's going to be the buying opportunities that a lot of folks are thinking. I fully believe there'll be some opportunities in the note space for some mezz lenders and some pref equity guys who maybe put out a little too much. They're getting beat up and they got to get out. And if you're a good operator, you could step in. But even those, the bid ask spread we're seeing is 10 to 15% between buyers and sellers, you know. Said another way, if you could buy a note for par, you know, yesterday, the seller still wants par today and I want to pay 85 cents. So I think it'll be interesting. One of the things we learned from the last crisis was it takes usually 12 to 15 months for bad product and defaults to roll through, because you do things like you exercise forbearance, right, which is much more prevalent this time around than last time because the banks were hurt last time and it was real estate driven. They didn't have the latitude to give forbearance to folks, right? But so you have the forbearance that's going to roll through. Then you have the operational pit that these folks have dug themselves into, because let's face it, if you're not paying your mortgage, you're not paying your payroll, you're probably stretching utilities. Unless your taxes are escrowed, you're probably pushing tax payments. So now, you know, 3 months after forbearance is done, it's month 6, and you're like, oh my God, you know, I have, you know, $30,000 of accrued payables and I have back taxes. And, you know, it's kind of a death spiral, right? If you don't get the rent growth, and to Ellie's point, we're not pushing on value add either right now. We think it's 12 to 18 months out before you can raise rent. So we're underwriting. And if a deal makes sense where you can get no rent growth then and do it later, then we'll move forward. But you're in this kind of operational pit and it's a death spiral. So I think what you'll end up seeing is, like history has showed us, 12, 15, 16 months out, you're going to see those opportunities come up because people will reach their pain threshold and they'll say, you know, that's it. I'm taking my ball and I'm going home. Multifamily is resilient. I'm going to put this on the market, get whatever I can. But by that time, the property will be operationally challenged. So you'll end up seeing probably 10, 15, maybe 20% discount on challenged assets. And I think it's going to be in the small operator space. You know, we'll be fine, right? We have corporate resources. We've built our company to be durable. But I think your average mom and pop owner, sadly, that might have bought a building, a 20-unit building, husband and wife, and they said, this is going to be our retirement plan. You know, they might be toast. And real estate companies didn't qualify for PPP during this. So you got that added layer of stress that a lot of folks don't have, where you're going to come up with the money to fund. And, you know, when your property is generating very little income, or the income is stressed and your operations are high, that margin, you know, that 0.25, 0.30 debt service, you know, buffer you underwrote evaporates very quickly. So I think that's what we're going to see. And, you know, we're going to hold steady, continue to, you know, evaluate opportunities, and our lenders will be there to support us. So we're very thankful for that.
So before we discuss the operational side of the business, we are starting to get short on time. Ellie, I want to ask you how the conversation with your investor base is going. Are they looking for new deals, or are they kind of wanting to sit on the sidelines and see where things go?
So it's kind of a mixed bag, and I definitely see a correlation between how experienced an investor is and how they react to this new reality. So those who have started to invest post, 2008 or in the last few years, and those who have, less money than other investors. And I think it's pretty natural. They're kind of waiting on the sideline to see what's going to happen. But those who've been through multiple cycles, those who have been investing for a long time and have diversification of investment portfolio, they are openly looking to deploy capital. I actually receive emails on a weekly basis from investors and text messages saying, hey, Ellie, hope everything is fine and you're safe and healthy. when do you have the next deal? I have capital to deploy. I want to invest money. So, you know, a lot of investors, you know, felt the pain from investing in the stock market as well. And they've pulled their money out of the stock market and they're waiting. They want to deploy the capital. And I think I've noticed also a shift in mindset in two ways. One is looking at the returns and adjusting the view for today's reality. So, you know, pre-COVID, we were looking at, I would say 8 to 9% cash on cash every year and about 15 to 17% IRR. That was pretty reasonable, pretty, you know, standard. Now we are, because we're very conservative and we assume, like Frank said, that there's no rent increases in the next 12 to 18 months and sometimes more than that, then we're adjusting our expectations. So we're not looking for 9% cash on cash. We're looking at 7, for instance, which is, in my opinion, still very good compared to other, you know, investment types that you have out there. We're not looking at 17% IRR. We're looking at 13 to 15 because that's what there is in the market. And I refuse to, you know, take an investment and put a little bit, you know, nicer, kind of painted in nicer colors. This is the reality. That's what we can find. And that's what I feel comfortable presenting to investors. So that's, you know, one part of changing the mindset. The second part is, you know, some investors are looking at real estate and multifamily specifically, and they're looking at it as a vehicle to conserve their wealth, not so much a vehicle to make money and double their investments in 5 years, but something that can, you know, if their value can steadily grow, maybe not as much as it was before, but see it as a wealth conservation tool or mechanism. That's what they want, because otherwise, if they leave $500,000 sitting in a bank account or somewhere else, this money is not growing. So this way, or, you know, they're actually going to lose some of the principal. So in that way, they're looking at moving their money away, you know, to real estate, you know, even more than before, because even if they're not looking for a nice fat, you know, bonus by the end of 5 years, they're looking at it as a way to conserve their wealth. And in addition, you have things that you just don't have in the stock market or in any other investment types, which is, you know, you can basically deduct the income. You can have technical losses on paper from cost segregation, which is accelerated depreciation that we do with every property, with expenses, especially with value add. So for instance, one of the deals that we bought in October of last year, for every $100,000 investment, we show loss on paper for the IRS for 75% of $75,000. So they have a $75,000 loss that they can deduct against their other sources of income, even though we've made the projected return, so the investment is profitable. So all those things, you know, you don't have those benefits when it comes to investing in the stock market, for instance.
Yeah, I think, Mark, I just want to touch on there really quick, because I think what we're seeing is it's a selectivity bias, right? So folks that have made money with, let's say you, or, you know, you as in, let's say any investor, folks that have made money with them and that are a little bit more liquid, have lived through, like Ellie mentioned, several cycles. This is the time they want to get greedy. So they know if you have a good opportunity, it's going to be a money maker, and they're willing to take that risk. And, you know, K1 income is incredibly powerful income, right? Because it's loss, you know, tax advantaged income. So, you know, tactical depreciation and cost seg, we're able to, you know, there's been times let's say a property generates on average an 8 or a 9% cash yield. You know, for a 40% AGI person, which is not uncommon, by the way, New York, New Jersey, California, because our tax brackets are really high, in some cases it could be 13 to 15% effective yield. And a lot of times your investors, right, who they're savvy, they don't only invest with you, right? They invest in other kind of non-public market, you know, alternative investments. So now they can take income that they have there, and not only are you giving them income, but you're also shielding their other income. So you become very powerful. And yes, you know, do they get additional yield because there's an illiquidity premium over a public market? Absolutely. But I think if you can show your investors that you're a good steward of capital, you're transparent, you make prudent decisions, and ultimately you can weather storms, especially like the one now, you enter that sort of realm of that selectivity bias where someone says, okay, I have Frank or I have Lucern Capital and I have capital firm X. And you know what? I only have 100,000. I'm going to put it with Frank. And I think, the last few years, you've seen a lot of folks rush into the space that I like to say played real estate investors on TV. And, they didn't really understand kind of what they were getting into. So they make these projections up. They're great salespeople. They can raise money, but then they can't perform. And that's sad because it hurts it for everybody else who's going out there doing the right thing and putting out great product and returns to their investors. But I think you'll see a lot of those folks clear out. And that's overall, it's positive for us as an industry because we'll be able to, increase folks' trust and overall make it a larger asset allocation of most people, not just folks who are going to put 250, 500, a million into our deals. So we're always happy to educate folks and be a part of that. I think it's a great, everyone should have an allocation towards real estate.
So it looks like we're running out of time, and I would like to take some questions and questions from the audience. If you do have a question, you can submit it at the using the Q&A at the bottom. Before we go to questions, we're going to do a lightning round, and we're going to ask each of you, what is your biggest lesson and biggest takeaway that you've learned from this crisis? So let's start with, well, Frank went last, so let's start with Ellie for the lightning round.
Biggest lesson, and what was the other part?
It just, what's your biggest takeaway? Like, what have you learned?
Be conservative. Being conservative always pays out. I cannot tell you how many deals I've turned down throughout my career, and I'm just grateful. The best deal you've ever done is the one you didn't do. So I just being conservative, underwriting, knowing that there might be a chance you're going to get those rent bumps, but just be conservative. If you think you can get 4% rent increases, just use 2.5 or 3%. Have more money for unexpected capital expenditures. And right now, it seems to be working well because we have those cash reserves that we can tap into, and that's all part of being conservative. So this has served me pretty well so far.
Hey, Frank.
So mine is more of less of a real estate lesson, and we kind of always live by that conservative mindset too, which is nice to see it finally, paying dividends to all of us folks who didn't, overblow our projections. But mine was more of a life lesson. I'm a very extroverted, touch and feel, social, have to be out talking to people sort of person. And what that means is I'm regularly visiting our properties, interacting with the folks that we do business with and who work for us. And that is really partly what allows us to get that extra bit of return, right? Because we're able to see and tweak and make things on the fly. So I was very nervous in part when this began because I said, wow, this is going to be really challenging running essentially what's becoming a national company, right, from New Jersey. And what I learned is that people are way more resilient than we give them credit for. And our company is more durable than, I even thought in my head. And I've been able to quite effectively, honestly, run our company from New Jersey with way less interruption than I had anticipated. So I've learned that, this whole kind of virtual thing, Zoom and video calling and everything, it's actually incredibly powerful. And I think going forward, we're going to see people adopt tech in a much broader way. And people who are resistant are going to finally this is going to get them off the fence, and they're going to move to the dark or the light side, depending on which way you look at it. But I think that's what I've learned during this.
Right, so let's go to a question from the audience. This question says, what upside is there for properties if you can't raise rents? If anybody
That's an excellent question. Yeah, I can take it. So part of it is operational. From the operational aspect, if you can lower the costs and manage the operation in a more streamlined or, cut costs basically, then you can have a much bigger bottom line. That's one thing. The second thing is I do believe that even if in a short term, 12, 18, months, we can't really raise rents, and perhaps we would, but at least for underwriting purposes, there's still, in the a year and a half, 2 years from now, we can still try and implement value add plan or go back and increase rents. And that's another way. A third way is actually to look at increasing income, but not on increasing rent. So for instance, when we buy a property, and you can still do it now, we're looking at all the other, it's called additional income, all the other fees that we're charging. So for instance, we found that in one property, the owner didn't charge pest control. So you add that, and you can increase the all the other fees. Like for instance, it can be anything, application fee, you can increase it by 10%, and it's not going to be a major issue in some markets, especially if you're in the right market. Another way is to implement RUBS, which is ratio build back utility system, which basically, the very short explanation is that you can have a higher income by charging tenants much higher portion of their bill on utilities. And that's another way of increasing income. So there are a lot of kind of very creative way of increasing income and making a deal work, even if you can't raise rents, because rents cannot raise, they can't rise forever. So there got to be other ways where you can basically increase the income. And just one last idea that we have been implementing is take the common area, because we're basically purchasing in Texas, Florida, and Georgia. We are purchasing properties with common spaces, and it's garden style apartments. And you can basically take a little portion of the clubhouse and turn it into a WeWork like station. So it doesn't cost more than $10,000. You put a coffee machine, you put a bunch of plugs, and basically chairs and some tables, and voila, you have WeWork, and you can open it and rent it for $200, $300 for the non-tenants, and give it as a perk to your current tenant to attract new tenants. So that's one idea of kind of using what you have and increase your bottom line without raising rents.
Okay, and then let's go to my good friend Glenn Spiller wants to know, what are the thoughts on co-living post-COVID, having been shown up at this point as an effective platform for affordable quality housing? So yeah, what's basically your thoughts on co-living post-COVID?
Yeah, sure. So I think people are going to take a hard look at it. I think there'll always be a need for a lower cost living alternative, right? Which is really what co-living was born out of, high density cities, high cost of living. Folks still want to live there, have great entry level jobs. And a lot of them are maybe just out of university or college, and they don't mind sort of that arrangement, right? Because they're, in their heads, they've kind of just come from living like that. But I think people are going to think twice. And I think even more programmatic co-working, the WeWorks, the Industrious, Industrious, and I forget the third one, but I think those folks are going to have a really hard time because, look, there's always going to be a market for that, just like office, but I think it's going to change. I don't want to be squeezed in with 20 other people in a 1,000 square foot room, side by side, even with little like plexiglass partitions up. If you've seen any of these videos, right, how like these germs spread on airplanes from COVID. And I actually had a mild case of Corona that took 3 weeks to recover from. And let me tell you, I was mild and it took forever, and I was fatigued and I had a fever for 2.5 weeks. It sucked. Like, I don't ever want, if there's another pandemic or something like that, I'm going to go inside, I'm going to shelter in place, I'm going to, run our stuff and wait till the dust settles, because I was away from my wife and daughter for, 3 weeks. It was horrible. So I think the mindset is going to change. There's always going to be people who want to be a part of that, unless some vaccine or something comes out in the near term that quells people's fear. I think that's going to change, and you're not going to see it go away, but I think you're going to see downward pressure on rental levels, and you're going to see downward demand. And ultimately, if rents do decline or let's say stagnate, now maybe it's a better opportunity that you go to a product that is a large 2-bedroom floor plan or 2-bedroom plus a den, and you rent that with 4 people, and now you have real space, you have real amenities, and you're paying the same amount of money. So that's one of the things we're doing now. Actually, it's worth bringing up, is we have a loft building, let's say in Philadelphia, with huge units. They're 2 bedrooms that are massive, huge ceilings, huge units. we're marketing them as a live work option. And ironically, we have a WeWork right across the street from us, and their enrollment is going down dramatically. And we're grabbing new tenants who used to pay, you know, $700 a month for a WeWork. Now maybe they move in, it's someone and his girlfriend, and it's $400 more to upgrade to a huge 2-bedroom. And they come in and they love it. And now they're a tenant of our building. They get access to all of our other amenities. And ultimately, we're giving them a much more premium experience for a fraction of the price. Is it maybe as cool as WeWork? No, but you know, I never thought WeWork was that cool anyway. But that's just me. So.
Okay, so I don't want to keep you guys for too much longer. So we're going to go to one last question. And the question is, are both of you open to taking on new investors? And if so, how do we get more info and look at opportunities?
Sure. So I know that, I mean, as someone who represents Lake Capital, we are always looking for, you know, good partners out there and good deals. If anyone is interested in discussing investment opportunities, you can basically either Google Ellie Perlman and you'll see my website, and you can reach out to us through our website, or you can email me directly. My email is Ellie, which is ELLIE, at bluelake-capital.com.
Yeah, that's and just to kind of tag along, the same thing with us. We're always looking for new investors, and you know, we've been really proud that we've been able to grow our investor base to, you know, north of 300 retail investors, and we have a few small institutions that invest with us. We're also in the early stages of putting together an equity fund for later this year, which is going to be a very similar sort of product and focus that we look for now, but in an expanded fund vehicle that is going to give investors a really diversified sort of exposure to everything they love and like and feel about our product now. So our website is www.lucerncapital.com, LUCERNCAPITAL. And I believe at the top right, we have a box that says contact us. And if you fill that out, you'll get a message to us, and we'll respond back in short order. So thank you guys so much for your time today. I really appreciate it. And Ellie, it was a pleasure meeting you, and wish you the best of luck.
Likewise. Thank you so much.
I think you're muted.
Am I muted now? I think, yeah,
Nope, now we hear you.
Yeah, I said thank you. Likewise. Thank you so much. It was great, you know, chatting with you and hearing the great questions from the audience. So it's been a pleasure.
All right, so thank you guys both. Thank you both very much for doing this today, and thank you all for joining us. And we have some amazing programs coming up. You check us out at the Riverside Experience. We have some amazing programs. So thank you all very much.
Thank you so much, Mark. Thanks, Aaron.
All right,
Thank
bye
you.
now.
Take care.